Stop refreshing your portfolio. Close your trading apps. Forget the charts, forget the headlines, forget the noise that floods your screen every day. Because what you are about to hear is not commentary, not speculation, and not a forecast dressed up as certainty. What unfolded this week represents a structural rupture inside the global silver market, the kind of failure that only becomes visible after it has already happened and cannot be reversed. These moments are rarely announced. They do not arrive with alarms or official declarations. They arrive quietly, buried beneath normal market activity, while most people go about their lives unaware that the financial architecture they trust has already begun to fracture. For decades, silver appeared to trade as a unified global asset, one metal priced across continents by supposedly integrated markets. But beneath that surface, a dangerous distortion was growing. Paper claims multiplied far faster than physical supply. Inventories thinned, while industrial demand accelerated. Eastern buyers paid real premiums, while Western screens continued to quote prices derived from leverage in derivatives rather than metal. Analysts warned for years that these two realities could not coexist indefinitely, that paper silver and physical silver were becoming two separate assets sharing only a name. Until now, those warnings were dismissed as fringe thinking. As of Wednesday, January 14, 2026, they became undeniable fact. On that day, the global silver market did something it is never supposed to do. It fractured. Not symbolically, not gradually, but mathematically. Two prices emerged for the same ounce of silver at the same moment in time. In New York, silver futures surged to new highs, celebrated as a historic breakout driven by momentum and demand. Traders cheered, algorithms chased price, commentators framed it as enthusiasm, speculation, and optimism. But simultaneously, on the other side of the planet, physical silver settling in Shanghai reflected a completely different valuation. The difference was not trivial. It was not explainable by currency moves, shipping costs, or temporary dislocation. It was a contradiction large enough to violate the basic assumptions of global trade. 1 ounce of silver was being valued in two incompatible ways, and the mechanism designed to eliminate that contradiction failed entirely. That alone should have dominated global financial media. Instead, it was barely acknowledged, and that silence speaks volumes. In a functioning global market, such a situation cannot persist. Economists treat the law of one price as foundational. Identical goods must trade at identical prices across integrated markets, or arbitrage immediately erases the difference. If silver is cheaper in one region, traders buy it there and sell it where it is more expensive. Capital flows, prices converge, equilibrium returns. This process is not optional. It is the invisible plumbing of global trade. Without it, markets fragment into isolated pricing islands with no coherent relationship to one another. On January 14, 2026, that plumbing failed completely. The arbitrage bridge between East and West did not weaken, it collapsed. And the reason was not fear, regulation, or lack of interest. The reason was absence. The metal required to execute arbitrage was no longer available. This is the distinction between volatility and failure. Arbitrage is not theoretical, it requires physical supply. Traders do not merely observe price gaps, they attempt to exploit them instantly. And when they tried, they discovered that Western markets could not deliver silver at the prices being quoted on screens. Digital abundance collided with physical scarcity. When that happens, pricing authority shifts away from paper markets and toward whoever controls real metal. Once that shift occurs, it is extraordinarily difficult to reverse. The first public confirmation came from an institution that rarely makes noise, the United States Mint. On the same day the global price gap exploded, the Mint suspended sales of silver products, not briefly, not for maintenance, indefinitely. The explanation cited difficulties sourcing silver blanks at prevailing market prices. This phrasing sounds technical, but its meaning is profound. The sovereign issuer of the world's reserve currency could not purchase silver for coinage when it is experiencing a logistical inconvenience. It is confronting a credibility crisis. Moments like this are rarely acknowledged openly. Governments adjust language, revise definitions, or shift responsibility. Here, the admission was indirect but unmistakable. The quoted price no longer represented replacement cost. The number on the screen had become disconnected from the cost of acquiring real metal. Once market participants internalize that truth, trust erodes rapidly, and trust is the foundation of all paper markets. At the same time, vault data confirmed what the Mint's decision implied. Large quantities of silver were withdrawn from major Western depositories in a single session. These were not retail purchases or speculative trades. These were institutional withdrawals measured in millions of ounces. This behavior signals one thing above all else: possession. Capital was removing metal from shared custody systems and transferring it into private control, where it could not be rehypothecated, leased, or claimed by multiple parties simultaneously. This behavior has appeared repeatedly throughout history during periods of financial stress. It is the oldest instinct in finance. When confidence fades, ownership matters more than yield. The futures market revealed even a deeper layer of stress. An unusually large number of silver contracts stood for physical delivery instead of cash settlement. Futures markets were designed primarily as financial instruments. Most contracts are rolled forward or settled in cash. Physical delivery was always intended to be the exception. The entire system depends on that assumption. Commodity exchanges operate on fractional reserves. There are far more paper claims than physical bars. That imbalance is sustainable as long as most participants agree to not demand metal. When that agreement breaks, the structure faces an existential threat. Delivery demand is not a normal market statistic. It is a warning signal. When traders insist on metal instead of dollars, it means confidence in paper settlement has eroded. When that demand reaches scale, it exposes the mismatch between claims and inventory. Once exposed, that mismatch cannot be unseen. It becomes the dominant risk in the system. This shift places extraordinary pressure on balloon banks that spent decades operating under very different assumptions. For years, selling silver short was profitable. Paper supply could be created almost infinitely. Rallies could be capped. Volatility could be harvested. Risk models assumed that physical delivery would remain rare and manageable. Those assumptions are now failing simultaneously. Rising prices alone are survivable. Inability to source metal is not. When counterparties demand bars instead of cash, paper hedges cease to function. At that point, institutions face a stark choice: default or capitulate. Evidence increasingly suggests capitulation is underway. Short positions are being closed at severe losses. Institutions that once suppressed price advances are now aligning with physical demand rather than fighting it. Attempts to slow or reverse this transition have failed. Margin increases, a standard regulatory tool designed to cool markets and flush out speculative leverage, produced only brief pauses before prices surged again. This response reveals something essential about the nature of current demand. This is not a rally driven by fragile retail speculation. It is driven by buyers who cannot exit. Industrial users, governments, and strategic institutions do not sell because margins rise. They buy because production and policy require it. When demand becomes inelastic, financial control mechanisms lose their effectiveness. Silver, however, does not move in isolation. Gold confirms the signal. Gold is not a speculative asset. It is the foundation of the global monetary system, held by every central bank on Earth. When gold breaks out decisively, it is not enthusiasm, it is repositioning. Capital is evacuating currency exposure and seeking assets with no counterparty risk. Gold does not move violently without cause. When it does, it signals systemic stress. Silver follows gold, but with leverage. Its market is far smaller, its liquidity is thinner. Capital that flows into gold inevitably spills into silver once gold becomes scarce or prohibitively expensive. This relationship is mathematical, not emotional. Historically, silver amplifies gold's moves by a factor of 2 or 3. What we are witnessing now fits that pattern precisely. While financial demand accelerates, industrial demand is doing something even more destabilizing. It is hoarding. Manufacturers cannot pause production lines. Solar panels, electric vehicles, electronics, medical devices, energy infrastructure, and military technology all require silver. When prices spike suddenly, buying behavior changes instantly. Buyers do not wait for prices to fall. They rush to secure inventory before shortages worsen. Scarcity triggers panic buying. This behavior removes supply from the market and reinforces the price signal, creating a self-reinforcing loop. Once manufacturers abandon just-in-time inventory models and shift toward just-in-case hoarding, markets enter a supercycle. Supply disappears faster than production can respond. New mines cannot be brought online quickly. Geological constraints do not yield to price signals in months or even years. That means scarcity persists, confidence does not return easily, and prices tend to overshoot expectations. These cycles historically last far longer than most participants anticipate. Now add the final catalyst, public awareness.
For years, silver climbed quietly, largely ignored by mainstream financial media. That silence was not accidental. Acknowledging the sustained rise in monetary metals is an implicit admission of currency debasement. But silence cannot hold forever. When price moves become too large, coverage begins. When coverage begins, retail demand follows. That demand will collide with a market already stripped of inventory. Dealers will sell out. Premiums will explode. The quoted futures price will become irrelevant compared to the price required to actually obtain metal. This divergence between screen price and physical price is already visible in markets around the world. At that point, resolution becomes unavoidable. The gap between Eastern physical pricing and Western paper pricing will close, but it will not close through physical prices falling. It will close through paper prices rising. Reality sets the floor. Leverage cannot suppress scarcity indefinitely. New York will rise to meet Shanghai, not the other way around. That adjustment is already underway. January 14, 2026 will likely be remembered as an inflection point. The day unified pricing collapsed. The moment when decades of paper dominance gave way to physical authority. This is not merely a silver story. It is a story about trust, currency, and the limits of financial engineering. If you are paying attention now, you are early, and what comes next will not unfold quietly.